Hello and welcome to this session in which we would look at corporate governance and how does corporate governance help in reducing fraud risk. Now the first thing we need to define is what is corporate governance. Corporate governance is who's in charge of the company and how is the company run. Usually you will have upper level management, middle level management, maybe a board of directors, audit committee. Those are all part of how the company is run, how corporate governance is active at the company. So corporate governance refer to rules, practices, and processes that comes from management that guide and control a company to ensure accountability and fairness in its operation and relationship with its stockholders. So how would we run the company internally? How do we treat our employees? How do we treat our customers? This is basically the structure of running the company. Who's in charge? Well, usually if it's a small company, management is the corporate governance. In publicly traded companies, you have a board of directors, you have an audit committee, you have upper level management, lower level management. They're all part of the corporate governance. So how do corporate governance relate to reducing fraud risk? Now, when it comes to the AICPA, the American Institute of Certified Public Accountant, they highlight three critical elements in corporate governance. So what they think is you should have those three elements in corporate governance to be not in good shape, to really have a strong corporate governance that reduce fraud. And those are creating a culture of honesty and high ethics. So part of any corporate governance is you have to have a culture of honesty. Culture of honesty amongst who? Amongst management and high ethics. Also, management, they need to understand their responsibility in evaluating fraud risk. Do management understand what is their role in combating risk and evaluating fraud risk, and the strengthening role of the audit committee? Now we'll talk about the audit committee later, but the audit committee is that subcommittee from the board of directors that's in charge of the external auditor. And why we have an audit committee? Again, we have a long discussion about this. The audit committee is supposed to be independent from the board of directors, independent from management. So the audit committee will hire the auditor, the external auditor, who's going to help in corporate governance, because auditing is also part of corporate governance, make sure the company is running properly. So the audit committee should be independent from everyone, so it doesn't have to respond to anyone. So if the auditor raise an issue to them, they are independent to act. Now in this session, we would look at those three critical factors that the AICPA highlight that are critical elements in any corporate governance. As always, I go through it step by step, starting with the culture of honesty, understanding management responsibility, then talking about the audit committee. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Before I proceed any further, I want to give you this rule. Maybe you heard of it, maybe not. And that's 10-80-10 rule in fraud. I'm not sure if you ever heard that the phrase, the tone at the top sets the stage. What do I mean by 10-80-10? This applies more than ever when it comes to reducing fraud. What does that mean? It means we have 10% always ethical. They always do the right thing no matter what. And you have 10% of the people, generally 10% means from a particular population, that are always unethical no matter what. whether you supervise them, not supervise them, just unethical people. Okay? But we have the majority, 80%. So what about the majority? Are they ethical or the unethical? Research shows that the 80% follows whoever in charge. So that's why whoever in charge is important. You want the ethical people to be in charge. Why? Because if the ethical people in charge, now theoretically you have an organization with 90% ethical people versus you have a 90% with unethical people. So that's why you want the tone at the top, the people on the top, to be ethical. The actions and attitude of the leadership directly influence the ethical behavior of employees. So you have two individuals, depending on, if this is the ethical person, they would influence if this one is not in charge, or if this individual in charge, then they will influence the group behavior. So that's why it's important. So without honesty and integrity, the risk of unethical behavior skyrockets, and this is based on this 10-80-10 rule. Because think about it, if you work at a company and you notice your manager is unethical, your manager don't care about customers, your manager don't care about, they cut corners, they don't care about ethics, well, guess what? If you're below that manager, you're going to act the same way. Whether you are ethical or not, you're going to be influenced by that. Therefore, it's very important, the tone at the top. So the key component is being ethical company culture. This is the tone at the top. They must set clear examples of honesty and integrity. And this is not about what the leadership says or what they post on their website, it's what they actually do. So employees take their cues really from upper management. So how upper management is acting or behaving, they take their clues. For example, if leaders cut corners or prioritize numbers over ethics, it sends a dangerous signal to staff. And why do I have Wells Fargo, picture of a Wells Fargo, the bank, on the slide? And the reason is because I want to talk about Wells Fargo. Wells Fargo, what they used to do, they used to put, not anymore supposedly, a lot of pressure on their employees, on their tellers, on their loan officers, on their customer relationship people to do what? To open accounts, to sell product. So what happened is this. Since most of the people don't want a new credit card or a new bank account, because of that pressure, it led salespeople and employees to create fake accounts. Why did they do that? Why did the employee create fake accounts? Because the tone of the top implicitly encouraged this. The tone of the top knows if you're going to the bank, you're not interested in opening an account. You want to do, whatever you need to do, send a wire, withdraw money, you have an issue to resolve. What they wanted to do, they wanted the employees to sell you goods. And since the employees could not do it and they were under pressure, either you do it or you get laid off, you're let go. So people were committing unethical behavior. Now that's why when you go to Wells Fargo now, before you leave, they give you a piece of paper listing exactly what they did. So you're aware of what they did. This is part of their internal control. Even if you go there to send a wire, and sometimes I go there to send a wire, they'll give me like a piece of paper. We met on this date, blah, blah, blah. And this is exactly what we did. We just send you a wire. You can keep it for your record. So in case an account is open in your name, and actually I had few accounts open in my name because I've been with them for a long time. But that's what I mean by the tone at the top. That's very important. Also, a positive workplace will have a positive influence on ethics. Happy employees are far less likely to commit fraud. Far less likely. It doesn't mean just because you're happy you don't commit fraud. They're far less likely. And research shows wrongdoing is less common where companies are supportive and create a positive atmosphere. If you work in a place and the management or the owner is supportive, create a positive work atmosphere, most likely you will not commit any fraud. When employees feel respected, valued, safe, they are more likely to stay aligned with the organizational goal that's on paper. So think about it. Would you go above and beyond for a company that disregard your well-being? And the answer is not. You do your job and you go home. And if you have an opportunity to commit fraud, you might, because you don't care about the company. But when the environment is positive, you are less likely to do that. And research shows that. Also, part of the ethical company culture is hiring and promoting the right people. Company, at the end of the day, company is people, because the people are the front end of any company. At the end of the day, you don't deal with You deal with people, you don't deal with product. So you want to make sure you hire the proper people, the right people. So prevention starts during hiring. So when you hire someone, make sure you run a background to ensure the candidate align with the company's ethical standard. If this person committed fraud, securities fraud or money laundering, you don't want to hire them at a bank or a financial institution. Screening practices, you want to verify their education. If they said they went to that school, they studied this, do that. Employment history verification, you want to check their references. You want to check their credit to see if they have any financial pressure, because financial pressure already, you have one area of the fraud triangle: incentive and pressure. It doesn't mean you're going to commit fraud, but you already have one area. You will look at their past criminal act that could potentially have an impact on their job. Promote trustworthy employees who demonstrate honesty and hard work, and stay away from those who don't. So this is what we mean by this is creating ethical company culture. Other key component of ethical company culture is providing the proper training. You want to train your employees, make sure they are competent, they can get the job done. Okay, and this is an ongoing ethical training, actual training, ethics and actual training, operational training. Companies need to repeatedly educate employees about their specific responsibilities and what to watch for. New hires should know what's expected of them. An existing team member should periodically confirm they understand and follow the organizational code of conduct. That's part of an ethical company's culture. Also, when a person commits a violation of that code, you should be accountability and discipline. Think of a place where you work and you know of someone that committed a wrongdoing and they were not disciplined. What message would that send you? Okay, so rules without consequences are just suggestions. So companies must enforce policies consistently and discipline people who commit those violations. So failing to act when someone violates the code of conduct could send a dangerous signal to others that misconduct is acceptable. Also, you want to terminate employees who commit serious ethical breaches. Why? Because you want to protect the company's reputation. Now let's move to the management role. Management they run the company. That's the central corporate governance. So what is their role? Well, they have to know about what possible areas fraud could be committed. So they have to identify and manage fraud risk. So keep in mind, no organization is immune. They cannot say there is no room for fraud. It won't happen here. And that's the first mistake, because it could happen anywhere. It could happen in a church, and fraud could happen anywhere. So fraud occur anywhere and by anyone. Also, responsibilities of management is to identify and measure the risk. They must actively assess where the risk is most likely to occur to deal with it. And this involves recognizing opportunities where employees might exploit, understanding the incentives, and narrowing down areas of weaknesses and creating responses to these areas. Other responsibilities of management is implementing and monitoring controls. Strong internal control reduce fraud opportunities. And this is what we mean by narrowing down areas of weaknesses to respond to them, to create strong internal control. You could also, as a management, conduct surprise audit. Always the employees, you're going to let them know at any time you could stop by to check on their work. That will keep them deterred. And that's very important. Deterrence is more important than fixing the issue when the fraud happens. You want to deter, to prevent the fraud from happening, and that's the most cost-effective way. One example of it is surprise audit. So when employees know that an internal team might knock on their door anytime to review the record, they are less likely to take an ethical action, and that's the cheapest, most effective way. Stop the fraud from happening. Don't deal with it after it occurs. Try to deter it, to prevent it right from the get-go. However, establishing control isn't enough. They must also be monitored on a regular basis to ensure they maintain effectiveness. So even if you say you're going to do surprise audit, do it on a regular basis. Also, you have to work with internal auditors, because companies, they might have internal auditor that work for the company and they have to cooperate with them. Internal auditor help ensure employees follow existing processes and control, and they could be the one doing also the surprise audit. Their jobs include identifying gaps, verifying compliance, and without feedback from auditors, it's easy for control to lose their relevance over time, because You have to update the control on regular basis. So again, another element is management responsibility. Are they doing their job in evaluating, identifying, and dealing with fraud? The third critical element is the audit committee. That's a critical line of defense. Responsibilities of the audit committee is to monitor management. Remember, management is responsible for fraud, then we need someone above that. The audit committee keeps an eye on management to ensure they are not abusing their authority or overriding control. And this oversight requires independence. The audit committee must be formed from independent people. If they are not independent, their ability to investigate and challenge might be compromised because you're challenging management. So you need to be independent from them. In other words, they cannot control you. You have the power to challenge them and hold them accountable. Reviewing internal audit finding. Internal auditors should report directly to the audit committee, not management. So if you find something wrong with management, you tell the audit committee, and the audit committee is supposedly above management as an external independent party. This ensures a clear flow of information and prevent any pressure from senior leadership to hide any issues if anything is going on. So if auditors uncover fraud or ethical breaches, they can confidentially report this information to the committee, which they can push management to take the necessary corrective action. We're talking here internal auditor. Also external auditor report to the audit committee, and make sure you're aware of this, that the audit committee also hire the external auditor. So the internal auditor report to them, the external auditor report to them. Now, for the external auditor, they must. For the internal auditor, it could be a company policy, but if you want a proper company policy, you want the internal auditor to report to the audit committee, not to report to management, because they are auditing management. You don't want to audit management and be accountable to management. Also, responsibilities of the audit committee: investigate any whistleblower claims. What are whistleblower claims? Someone from the company just contact someone in upper level management, tell them this is going on. So companies that encourage whistleblowing must ensure that the audit committee review any significant report, because if there's a whistleblowing, it means this person is going above the head of their immediate supervisor. So must be a serious claim. And if it's a serious claim, they should be never ignored, and whistleblower deserve protection. They should not be fired or disciplined as they bring forward critical information. So when the audit committee function properly, they would provide a crucial layer of accountability, thus reinforcing ethical behavior that we talked about. This is an important element. Now keep in mind, these elements, they all have to work together. In a sense, you have to have a good ethical company culture. You have to have an audit committee. You have to have management work together to reduce fraud effectively. So when leadership prioritize integrity, management enforces checks and balances, and the audit committee holds everyone accountable, this would result in a workplace that deters fraud and builds trust. And when external auditor review the company, a strong system of control sends a clear message that the organization is serious about maintaining ethical practices. So you have the people inside the company, and the external auditor comes and just kind of give you more strength to that system, because now it's being audited by an external party. Let's take a look at this multiple choice question from farhatlectures.com. What is the main reason for management to emphasize fraud prevention and deterrence? So why would management want to emphasize, it means advertise, promote, fraud prevention and deterrence? A, collusion is impossible to detect. No, actually collusion is possible to detect, but that's not why that's not the main reason they prevent they emphasize fraud prevention and deterrence, and collusion is possible, not impossible. So the statement by itself is incorrect. The AI CPA require management to implement a fraud prevention program. Not necessarily, they don't require you, but they tell you what are some key elements of it. Focusing on fraud prevention and deterrence is often more effective and economical than focusing on fraud detection. Yes, what you want to do is you want to go with fraud prevention and deterrence. Why? Because it's easier just to stop the fraud from happening. Prevent and deter. Deter means scare people from committing the fraud, and prevent, having system that will not allow them. It's more effective. Of course, it's more effective and economical than fraud detection. When the fraud occur and you want to detect it, Well, it already happened. So between A, B, and C, I'm going to keep C. D, fraud prevention and deterrence should not be emphasized. No, it should be emphasized. And the reason is because it's cost effective. It's more effective. It's also cost effective because it's going to save you from your investigation. And when fraud happens, you have cost, reputational cost, monetary damage, and reputation is more important. But again, you want to prevent and detect rather than focus on fraud detection. Prevention and deterrence is the best way because you just cut it right from the get-go. If you can, what should you do? Now you want to go to Farhat Lectures, look at additional resources, multiple choice, true, false, additional lectures that's going to help you, whether you are an accounting student or a CPA exam candidate. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.